Have you ever opened a retirement calculator, typed in your age, your savings, and felt that quiet knot in your stomach? Maybe you thought, I'm doing okay, right? And then you change one number, your savings rate or your return, and suddenly retirement moves 5, 7, even 10 years later. Here's the truth. Most people don't retire late because they're lazy. They retire late because of a few simple mistakes that compound quietly in the background. Today, I want to walk you through three mistakes that can delay retirement by years, and more importantly, how to fix them without turning your lifestyle upside down. Let's start simple, then we'll go a little deeper. Okay, so why this matters. Let's ground this with real numbers. Imagine you're 32 years old, earning $85,000 a year. You invest $500 per month at a 7% annual return. By age 65, that grows to roughly $750,000. What's the key takeaway from this? Consistency matters more than intensity. Now, let's just change one variable. You wait 5 more years to start. You'd be 37 at this time. Same $500 per month, same 7% return. Now you end up with about $565,000. That 5 year delay costs you nearly $185,000. What's the key takeaway? Time is doing most of the heavy lifting. For beginners, that's the big idea. Small delays create big consequences. For mid level investors, it's even more subtle. Tiny inefficiencies such as fees, taxes, idle cash can quietly shave years off your retirement timeline. So let's talk about the three biggest ones. Mistake number one, waiting for the perfect time to invest. I hear this one all the time. I'm waiting for the market to calm down. I'll invest when stocks drop. I just need to feel more confident first. Sounds reasonable, right? Here's the issue. Markets don't ring a bell at the bottom. And historically, missing just the 10 best days in the stock market over a couple decades can dramatically reduce long-term returns. If you invest steadily into broad index funds, say an S&P 500 fund, inside a 401k or a Roth IRA, you're buying pieces of hundreds of companies. Over time, that has historically rewarded patience. Trying to time entry points often leads to sitting in cash. Cash feels safe, right? But long-term inflation erodes purchasing power. At 3% inflation, your money loses about half its value in roughly 24 years. The real cost isn't market volatility. The real cost is staying out of the market. So remember, sometimes it's better to have your money more time in the market than trying to actually time the market. Mistake number two, underfunding retirement accounts early. Let's talk about contribution levels. A lot of people in their 20s and 30s contribute just enough to get the employer match in their 401k, and that's good. The match is free money. But stopping there can slow you down. Let's use numbers again. You earn $95,000 and contribute 5% to your 401k. That's $4,750 per year. With growth, that might get you to retirement, but it won't create flexibility. The key takeaway here is the savings rate is the engine of early retirement. Now compare that to 15%. That's about $14,250 per year. Over 30 years at 7%, that difference can mean hundreds of thousands, even over $1 million more in retirement savings. If 15% sounds high, start with 8% and increase 1% per year. Most plans actually let you automate that. Think tax placement. Maxing a Roth IRA early in your career can lock in tax-free growth when your income and tax bracket are lower. Small percentage increases today can move your retirement date forward by years. Ask yourself, is your savings rate aligned with the life that you want at age 60? Mistake number three, lifestyle creep that eats investment growth. This one is sneaky. You get a raise, your income jumps from $80,000 to $100,000, let's say. What happens next? New truck, bigger apartment, nicer vacations? There's nothing wrong with enjoying your money. But if every raise turns into higher fixed expenses, your investing rate stays flat. Let's break this down. You get a $15,000 raise. After taxes, maybe that's $10,000 more a year. If you invest that instead of spending it, at 7% over 25 years, that one raise could grow to over $1,000. So remember, raises are retirement accelerators, but only if you treat them that way. For beginners, split every raise. Half to lifestyle, half to investing. Once you're mid level, fixed expenses are the danger. A higher car payment locks you in. Investing keeps you flexible. Retirement isn't just about portfolio size, it's about financial freedom, the ability to choose how to spend your time. Lifestyle creep quietly delays that choice. Okay, let's put this all together and zoom out for a bit. The three mistakes aren't dramatic, they're subtle. First, waiting to invest. Second, saving too little early. Third, letting lifestyle expand faster than investments. None of these require extreme frugality to fix. They require awareness. If you start investing consistently in low cost index funds, increase your savings rate gradually, and treat raises as fuel instead of spending money, you don't need heroic return. You just need discipline over time. Retirement planning isn't about predicting markets, it's about controlling behavior. And behavior is something you can change today. So here's the simple takeaway: start now, even if it's small, increase your savings rate with intention. Guard against lifestyle inflation. If this helped you think more clearly about your own retirement plan, subscribe to the channel. Every week we break down investing and retirement in a way that actually makes sense, without hype and without pressure. And if you're comfortable sharing, tell me your age and your current savings rate in the comments. Sometimes seeing where others stand reminds you that you're not behind. You're just building. Thanks for watching, and I'll see you in my next video.